Ladies and gentlemen, what if I told you that 99% of silver and gold investors are positioned completely wrong heading into 2026? Not slightly wrong, catastrophically wrong. The world is entering a phase of monetary stress, hidden currency devaluation, and geopolitical fragmentation that most market participants refuse to acknowledge. While they chase headlines and short-term price swings, the real drivers of precious metals are shifting beneath the surface. And when that shift becomes obvious, it will not be gradual, it will be violent, fast, and deeply unsettling for consensus thinking. What is unfolding in the global monetary system is not a sudden collapse, nor a visible break that appears on front pages. It is something more subtle and therefore more dangerous. A gradual transition into a hidden restructuring phase where the old rules still appear to function on the surface, while underneath their effectiveness is steadily eroding. Most participants in financial markets continue to operate under the assumption that central banks retain full control over outcomes through interest rates, liquidity management, and forward guidance. That assumption was broadly valid in the era when debt levels were manageable, growth was structurally higher, and inflation was the primary variable to stabilize, but that framework is now under strain. Debt has expanded to levels where it is no longer simply a financing instrument, but a structural constraint on policy itself. In such an environment, raising rates aggressively risks destabilizing sovereign balance sheets, while lowering rates risks undermining currency credibility. This is not a normal policy cycle, it is a narrowing corridor of choices. When systems reach this point, they rarely announce transformation directly. Instead, they adapt through layers of complexity. Liquidity is provided in new forms, often indirectly. Regulatory frameworks evolve to accommodate stress rather than eliminate it. Accounting treatments are adjusted to smooth volatility. At the same time, public messaging continues to emphasize stability, even as internal mechanisms shift toward preservation rather than optimization. This duality is what defines a hidden reset phase. Continuity in appearance, transition in substance. One of the most important characteristics of this phase is the changing role of money itself. Historically, money functioned as a neutral medium of exchange, a store of value, and a unit of account, but in periods of systemic stress, its role becomes increasingly political. Liquidity is allocated not purely by market forces, but by strategic necessity. Certain institutions receive priority access, while others face implicit constraints. Asset prices may remain stable in aggregate indices, yet the composition beneath those indices becomes increasingly fragile. Another critical dimension is the shift in how risk is perceived. In stable regimes, risk is distributed across markets through diversification and hedging mechanisms. In transitional regimes, correlations tend to converge. Assets that were previously uncorrelated begin to move together under stress. This creates the illusion of stability during calm periods, followed by abrupt repricing events when hidden linkages are exposed. The system does not fail gradually, it tightens until it can no longer absorb shock, and then it adjusts rapidly. Currency dynamics also become more complex in this phase. Official exchange rates may appear stable, but real purchasing power relationships begin to diverge. Gold and other real assets often start reflecting these divergences earlier than traditional indicators. This is not because gold is rising in a simple sense, but because fiat currencies are being reassessed against a backdrop of expanding liabilities and geopolitical fragmentation. The pricing mechanism shifts from growth expectations to trust calibration. At the institutional level, central banks face a paradox. They are tasked with maintaining price stability while also ensuring financial stability. In a high-debt environment, these two objectives can conflict. Tight policy may stabilize inflation but destabilize credit markets. Loose policy may stabilize credit markets but weaken currency credibility. The result is a form of policy oscillation that markets interpret as inconsistency, when in reality it is constraint. What makes the current environment particularly significant is the simultaneity of pressures. Sovereign debt expansion, geopolitical fragmentation, supply chain restructuring, and energy transition costs are all occurring at once. Historically, such adjustments were spread across decades. Today, they are compressed into a much shorter time frame due to the interconnectedness of global systems. This compression increases the likelihood of nonlinear outcomes. In a hidden reset phase, the most important misconception among investors is the belief that continuity implies safety. In reality, continuity often masks accumulation of imbalance. The visible metrics remain intact, while the underlying structure becomes more sensitive to disruption. Eventually, a relatively small catalyst can trigger disproportionate effects. The transition, therefore, is not announced through declarations, but revealed through behavior. Shifts in liquidity preference, changes in collateral standards, rising demand for real assets, and increasing divergence between nominal stability and real economic stress. Those who interpret these signals as noise rather than structure often find themselves unprepared when the adjustment becomes explicit. What appears to be stability is often the final stage before repricing. Silver has entered a structural transformation that most market participants still fail to recognize. For decades, it was categorized almost mechanically alongside gold, treated primarily as a monetary hedge or a speculative instrument that mirrored inflation expectations and macro uncertainty. That framework is no longer sufficient. The underlying demand profile of silver has shifted in a way that fundamentally alters its role in the global economy. It is increasingly embedded in industrial systems that are not cyclical in the traditional sense, but structural, long duration, and technologically driven. At the core of this shift is the acceleration of electrification across the global economy. Solar energy systems, which rely heavily on silver for conductivity and efficiency, are expanding at a pace that was not anticipated even a decade ago. Unlike discretionary consumption, this demand is policy-driven and infrastructure-based. Once installed, these systems require maintenance and scaling rather than replacement, which creates a persistent baseline demand for silver. In other words, demand is becoming less sensitive to price in the short term and more anchored to long-term strategic objectives. This creates an unusual dynamic in most commodity markets. Higher prices eventually suppress demand or stimulate substitution, but silver sits in a category where substitution is technically difficult without efficiency loss. It has the highest electrical conductivity of any element, which makes it irreplaceable in many high-performance applications. Copper can substitute in some cases, but not without trade-offs in efficiency, size, or energy loss. In advanced semiconductor manufacturing, medical applications, and photovoltaic technology, silver's properties are not optional, they are essential. At the same time, supply dynamics are not responding in a conventional manner. Silver is primarily produced as a byproduct of mining for other metals such as copper, lead, and zinc. This means production levels are not directly responsive to silver price signals alone. Even if demand increases sharply, supply cannot be expanded proportionally without a corresponding increase in the production of those base metals. This structural constraint creates a lag that is not easily resolved by market incentives. In practical terms, the supply side is partially decoupled from price discovery. This mismatch between structurally rising demand and rigid supply elasticity creates conditions where inventories become the primary buffer. Yet inventories themselves have been declining over extended periods, particularly in visible and exchange-registered stockpiles. When inventories thin out in such a system, price discovery becomes increasingly sensitive to incremental demand shocks. Small changes in industrial consumption can have outsized effects on availability and pricing because there is less of a cushion to absorb variability. What makes this transition even more significant is that industrial demand is not merely growing in volume, but also in strategic importance. Governments and corporations are now treating energy transition infrastructure as a national priority. This introduces a geopolitical layer to silver demand. Materials that were once traded purely on economic fundamentals are now partially influenced by strategic stockpiling behavior, supply chain security considerations, and industrial policy frameworks. In such an environment, price is no longer the sole clearing mechanism. Allocation and access begin to matter as much as cost. Meanwhile, the investor narrative has not fully adjusted. Many still view silver through a historical lens, expecting to behave primarily as a leveraged version of gold. While there is still a monetary component to silver's valuation, it is increasingly secondary to its industrial identity. This creates a disconnect between perception and reality. Markets often misprice assets during periods of functional transition, because they rely on outdated classification systems. Silver is one such case where the classification itself is becoming obsolete. Another important factor is the asymmetry of information embedded in industrial consumption. Large-scale buyers in manufacturing and energy sectors are not reacting to short-term price fluctuations in the same way speculative participants do. They are focused on continuity of supply. This leads to behavior that is more consistent and less elastic. When procurement becomes strategic rather than opportunistic, price sensitivity declines and structural demand becomes more stable. Over time, the stability on the demand side combined with rigidity on the supply side creates a pressure balance. That imbalance does not resolve gradually. It accumulates beneath the surface until inventories, liquidity, or pricing mechanisms adjust abruptly. In such environments, markets often appear calm until they are not. The transition from adequacy to scarcity is not linear, it is typically discontinuous. The broader implication is that silver is no longer functioning within a single narrative framework. It is simultaneously a monetary asset, an industrial input, and a strategic resource. Each of these roles interacts with the others, but they do not move in sync. This multi-layered identity is what makes valuation more complex and volatility more pronounced when shifts occur. What is often misunderstood is that the most important transitions in commodity markets are not driven solely by demand growth, but by demand quality. When demand becomes structural, non-discretionary, and strategically embedded, the entire pricing architecture changes. Silver is moving through that transition now, and the implications extend far beyond traditional commodity cycles. The conventional framework used to explain gold has become increasingly inadequate for understanding its current behavior. For decades, the dominant narrative tied gold primarily to inflation expectations, real interest rates, and currency fluctuations. In that model, gold was treated as a reactive asset moving in response to measurable economic variables such as CPI data or central bank policy adjustments. While those factors still play a role, they no longer define the core driver of valuation. A deeper force has emerged, and it is more structural than cyclical. Gold is now increasingly being repriced against the global level of trust in the monetary and sovereign system itself. This shift is subtle but profound. Inflation is a numerical phenomenon. It can be tracked, forecasted, and in theory controlled through policy instruments. Trust, however, is qualitative, fragmented, and far more difficult to restore once it erodes. When market participants begin to question the durability of fiscal balance sheets, the coordination between central banks, or the long-term stability of reserve currencies, they are no longer reacting to price levels in the economy. They are reassessing the credibility of the entire monetary architecture. In such environment, gold stops behaving like a simple inflation hedge. Instead, it becomes a direct measure of systemic confidence. When trust is high, gold remains subdued, not because inflation is absent, but because financial instruments and sovereign promises are broadly accepted at face value. When trust begins to fracture, however, the relationship decouples. Gold begins to move independently of short-term inflation readings, often anticipating stress that is not yet visible in conventional data. One of the clearest indicators of this transition is the growing divergence between real yields and gold performance. Historically, rising real interest rates would exert downward pressure on gold as the opportunity cost of holding a non-yielding asset increases. Yet, in more recent cycles, this relationship has become less reliable. Even in environments where real yields rise, gold has shown resilience or continued strength. This suggests that the traditional discounting mechanism is being overridden by a more dominant variable, the perceived stability of sovereign credit and fiat currency coordination. At the heart of this dynamic is the expansion of global debt. Sovereign balance sheets of major economies have reached levels where refinancing becomes a continuous requirement rather than an episodic event. Debt is no longer a temporary financing tool for investment and growth. It has become a structural feature of the system. When debt levels reach this magnitude, confidence in repayment is not just about ability, but about political will, institutional continuity, and intergenerational commitment. These are trust variables, not inflation variables. In parallel, geopolitical fragmentation has introduced additional layers of uncertainty into the monetary system. The post-war assumption of synchronized global economic governance is weakening. Trade relationships are being restructured, reserve diversification is accelerating, and cross-border flows are becoming more politically conditioned. In such a landscape, the notion of a single, universally trusted monetary anchor becomes increasingly difficult to sustain. Gold, by contrast, is not dependent on any sovereign issuer, which positions it uniquely as trust-neutral collateral. Central banks themselves have begun to reflect this shift in behavior. The accumulation of gold reserves has increased in multiple regions, particularly among countries seeking to reduce exposure to external financial systems. This is not a tactical inflation hedge, it is a strategic repositioning of reserve assets in response to uncertainty about long-term monetary alignment. When official institutions begin to favor an asset historically associated with monetary independence, it signals that the trust function of the existing system is being reassessed at the highest levels. Another important dimension is the psychological transition occurring in market perception. Inflation is typically viewed as a temporary distortion that can be corrected through policy tightening. Trust erosion, however, is viewed as structural and cumulative. Once participants begin to question whether currency purchasing power will remain stable over long horizons, their time preference shifts. They move away from nominal returns and toward assets that preserve value across regimes. Gold benefits directly from the shift in time horizon. This is why short-term macro indicators often fail to fully explain gold's behavior in recent phases. Employment data, CPI releases, and interest rate expectations still generate volatility, but they do not define direction in the same way they once did. Instead, gold increasingly responds to regime-level signals, debt sustainability concerns, central bank balance sheet expansion, geopolitical escalation, and reserve currency diversification trends. In this context, price discovery is no longer anchored purely in economic cycles. It is anchored in confidence cycles, and confidence cycles do not move in smooth patterns. They shift slowly, then suddenly, as thresholds are crossed. When enough participants begin to reassess the reliability of monetary guarantees, the repricing mechanism accelerates. Gold, therefore, is not simply reacting to inflation data points. It is continuously recalibrating against the evolving perception the global monetary system remains fully credible. As that perception becomes more complex and more contested, the role of gold expands. It ceases to be a reactive hedge and becomes a forward indicator of systemic trust conditions. The structure of modern investing is built on a distinction that is rarely examined with sufficient seriousness: the difference between paper claims and real assets. Most market participants assume that ownership recorded through electronic systems, custodial statements, or fund units is equivalent to direct ownership of underlying value. In normal conditions, this assumption appears justified. Liquidity is abundant, settlement systems function smoothly, and counterparties honor obligations without friction. But in systemic stress environments, that assumption becomes one of the most dangerous miscalculations in finance. The scale of exposure to paper-based assets has expanded dramatically over the past several decades. Equity indices, exchange-traded funds, futures contracts, structured notes, and synthetic derivatives now represent a multiple of the underlying physical or productive assets they reference. This layering of claims creates efficiency in normal times, but it also introduces structural fragility. The system is not merely holding assets, it is holding claims on claims, many of which depend on continuous liquidity and uninterrupted confidence in counterparty performance. The key vulnerability lies not in the existence of paper instruments themselves, but in their reliance on perpetual convertibility. Investors assume that exposure can be exited at will, that bids will always be present, and that underlying value can be accessed indirectly without disruption. However, this assumption depends on a stable liquidity environment and functioning credit channels. When those conditions tighten, the gap between paper valuation and realizable value begins to widen. One of the most important but underappreciated dynamics in such systems is the difference between price and liquidity. In calm markets, price discovery is efficient and appears to reflect true value. In stressed markets, price can remain quoted while liquidity evaporates. This creates the illusion of continuity even as the ability to transact at scale disappears. The distinction becomes critical for overexposed investors who believe that mark-to-market pricing guarantees exit capability. The concentration of wealth in paper assets has also introduced a second-order risk, systemic correlation. In theory, diversification across asset classes is meant to reduce risk. In practice, during periods of financial stress, correlations tend to converge toward one. Equities, bonds, credit instruments, and even certain alternative assets begin to move in the same direction, driven not by fundamentals but by liquidity needs. When this occurs, diversification provides less protection than expected because the underlying driver is not asset-specific risk but system-wide balance sheet adjustment. Another layer of complexity is the role of leverage embedded within paper markets. Many investors are indirectly exposed to leverage without explicitly recognizing it. Margin financing, derivatives exposure, and synthetic replication strategies amplify both gains and losses. In stable environments, leverage enhances efficiency and returns. In unstable environments, it accelerates forced liquidation. The problem is not simply exposure to assets, but exposure to magnified versions of those assets under conditions where liquidity is contracting. Physical assets, by contrast, operate under a different logic. Ownership is direct, settlement is final, and counterparty risk is minimal or non-existent. This creates a structural separation between paper claims and tangible value. In periods of stability, this distinction is often ignored because paper assets provide convenience, yield, and accessibility. But in periods of stress, the market begins to reprice the importance of finality and direct control. The growing divergence between paper and physical markets in certain sectors reflects this tension. When demand shifts toward physical delivery rather than contract rollover signals a reassessment of trust in the continuity of paper systems. This does not require complete breakdown of financial markets. It only requires a shift in preference among a sufficiently large subset of participants. Once that shift begins, it can become self-reinforcing as rising demand for physical settlement strains existing structures. Central clearing mechanisms and custodial systems are designed to absorb shocks through netting and collateralization. However, these mechanisms assume that collateral itself retains stable value and that counterparties remain solvent under stress. When asset correlations rise and collateral values decline simultaneously, the system relies increasingly on liquidity provision to maintain stability. If that liquidity is constrained or unevenly distributed, pressure builds in specific segments of the market. The overexposure to paper assets is therefore not simply a matter of asset allocation, it is a structural dependency on continuous confidence. The entire architecture functions on the assumption that claims can always be rolled, refinanced, or unwound without disruption. That assumption holds until it does not, and when it fails, the adjustment tends to be abrupt rather than gradual. What makes this dynamic particularly important is that it is largely invisible during expansion phases. Rising asset prices reinforce confidence in the system, encouraging further allocation into paper instruments. This creates a feedback loop in which perceived safety leads to increased exposure, which in turn increases systemic sensitivity. The result is a structure that appears increasingly stable on the surface while becoming more fragile underneath. Ultimately, the distinction between paper exposure and real ownership becomes most relevant not in periods of growth, but in periods of stress. It is in those moments that liquidity, settlement finality, and counterparty reliability move from background assumptions to primary concerns. And when that transition occurs, the difference between holding an asset and holding a claim on an asset becomes not theoretical but decisive. The trajectory of precious metals rarely unfolds in a smooth and linear fashion. History shows instead a pattern of long periods of apparent stagnation, punctuated by abrupt repricing events that reset expectations in a relatively short span of time. These transitions are not random. They tend to occur when multiple structural pressures accumulate simultaneously and reach a threshold where incremental adjustments are no longer sufficient to maintain equilibrium. The conditions forming toward 2026 suggest that such a threshold may be approaching for the entire precious metals complex. One of the defining features of the current environment is the layering of unresolved macroeconomic imbalances. Global debt levels remain elevated across sovereign, corporate, and financial sectors. This is not merely a question of size, but of composition and maturity structure. A significant portion of outstanding obligations requires continuous refinancing under conditions that are no longer as supportive as they were in the prior cycle of near-zero interest rates. As refinancing becomes more sensitive to rate levels and market confidence, the system becomes increasingly dependent on stable liquidity conditions to avoid disruption. At the same time, inflation dynamics have become less predictable. While headline inflation may fluctuate within defined ranges, the underlying price structure of essential goods and services reflects persistent upward pressure driven by supply chain reconfiguration, energy transition costs, and geopolitical fragmentation. This creates an environment in which nominal stability can mask real erosion in purchasing power. Precious metals tend to respond not to isolated inflation readings, but to the broader perception of monetary stability over time. Another important dimension is the evolving nature of global monetary coordination. The post-World War II architecture assumed a relatively coherent alignment among major reserve currency issuers and central banks. That alignment is becoming less stable. Divergent policy paths, shifting reserve compositions, and increasing use of alternative settlement mechanisms are gradually reducing the cohesion of the system. When monetary coordination weakens, the role of neutral reserve assets becomes more prominent. Precious metals, particularly gold, tend to re-emerge as instruments of settlement confidence rather than purely speculative instruments. Silver, while often grouped with gold, is simultaneously influenced by a separate but related structural dynamic. Its industrial integration into energy systems, electronics, and advanced manufacturing means that its demand profile is increasingly shaped by long-duration technological trends rather than short-term economic cycles. This dual identity, monetary sensitivity combined with industrial necessity, creates a unique precious structure that can amplify price movements during periods of systemic stress. What makes a potential breakpoint scenario relevant for 2026 is not a single catalyst, but convergence. Multiple independent trends are moving in the same direction. Sovereign debt accumulation is limiting policy flexibility. Geopolitical fragmentation is altering trade and capital flows. Energy transition policies are reshaping industrial demand for critical materials. Meanwhile, financial markets remain heavily dependent on liquidity conditions that were designed for a lower debt, more globally synchronized environment. Precious metals often respond to this kind of convergence with delayed but forceful repricing. In early stages, price action can appear disconnected from fundamentals, leading many participants to underestimate underlying pressure. However, as structural imbalances persist, the sensitivity of the system increases. Small shifts in sentiment or liquidity can produce disproportionately large price responses because available supply at marginal prices becomes thinner. Another factor that should not be overlooked is central bank behavior. In recent years, official sector accumulation of gold has increased, particularly among countries seeking to diversify reserve exposure. This is not typically driven by short-term profit motives, but by long-term considerations of monetary sovereignty and system resilience. When institutional actors with multi-decade horizons increase allocation to an asset, it often signals a reassessment of systemic risk rather than a tactical trade. Market structure also plays a role in potential breakpoint dynamics. A significant portion of precious metals exposure in modern markets is held through paper-based instruments rather than physical ownership. In stable conditions, this structure enhances liquidity and accessibility. In stressed conditions, it introduces dependency on continuous rollover settlement confidence and derivative market functioning. If confidence in these mechanisms weakens even modestly, the adjustment between paper pricing and physical demand can become abrupt. What distinguishes a breakpoint year from a standard cycle is not just the direction of price movement, but the speed and discontinuity of, instead of gradual appreciation or depreciation, markets begin to move in gaps. Valuation regimes shift as participants reassess assumptions that previously appeared stable. This is typically when long-standing correlations break down and new pricing relationships emerge, if 2026 becomes such a period, it is unlikely to be the result of a single identifiable event. More plausibly, it would reflect the cumulative effect of structural pressures that have been building for years. Debt dynamics, monetary fragmentation, industrial realignment, and trust recalibration would converge into a single adjustment phase. Precious metals, by their nature, tend to reflect these transitions earlier than most asset classes because they sit at the intersection of monetary confidence and real asset demand. In that sense, the significance of the period is not that it creates new risks, but that it reveals existing ones that have been accumulating beneath surface stability. When that revelation occurs, markets do not simply adjust, they reprice the assumptions on which prior pricing was built.